Welcome, guys, to another episode. I'm really excited for this one today. A lot of you in the comments have been asking on, financial videos, talking numbers. I know you get excited about that in the comments section. So today I've got a special guest who's going to get into the numbers with us and really demystify finances when it comes to dentistry. We have Shoaib Khan, who is a principal for Black Swan Tax, and he's the man. If you want your numbers to be straight within dentistry, this is the type of guy you come to see. So Shoaib, first of all, thank you for being with us today.
Thank you. That was a really generous introduction and much appreciated.
So just demystify to us, what you do,
Sure.
What your background is, and we'll take it from there.
Yeah, sure. So I've been doing tax for 12 years. Spent most of my career at Big Four accountancy firms, so Deloitte and KPMG, and sat on KPMG technical team. So that's the team that comes up with all the planning ideas. And decided it was time to set up my own practice, which is Black Swan Tax. So I've got myself and other partners, and we are a tax and accountancy specialist firm. So that means we do your accounts, your tax returns, but we have a lot of strength in the tax advisory space. So if it's UK taxes, we're able to advise you.
Yes. So, okay, you said quite a bit there. Talk to me like I'm a 5-year-old. So, what's the difference here between tax advisors, accountants, financial advisors, wealth management,
Sure.
individuals, just try and explain some of the differences between these different roles. Because, to some of us, it all seems like the same thing, different flavor. Can you?
Yeah. So a lot of people will treat us all kind of within the same bracket just because we're in finance and we can do everything for you, but there is specialism. So for example, as a tax advisor, I can't give investment advice, right? So you need to speak to a financial advisor. Equally, I'm not an accountant, I'm a tax advisor. And what that means is tax is a specialism within accountancy. And I've always been a specialist. So if you can think about it from a dentist perspective, you can be a general dentist or you can be a specialist. It gets not a direct comparison because you have specialist interest as well in dentistry. So not quite a direct parallel in that sense. But a lot of accountants are very good at preparing your accounts and your tax returns. They may not necessarily want tax. And in my mind, the way I see tax is you work a lot with the tax legislation, so it's kind of a marriage between law and accountancy almost. I don't know if that's the best way to describe it, but I hope you get the sense. And then when it comes to wealth management, so generally you'd be dealing with financial advisors. They're regulated by the Financial Conduct Authority, and they're able to advise you on what kind of investments you should make. So if you come to an accountant or a tax advisor, we'll be able to tell you maybe the tax implications of that investment. So I can't tell you, for example, if you're a centre of practice, I can't advise you, another investor to come and invest in your business as financial advice. They might come to me and say, well, look, if I invest in your business, what's the tax implications? I can help you there. So I hope that clarifies.
It does. And I like the fact that you pointed out, the parallel with dentistry in that I'm a general dentist and I've got a special interest in ortho. So I will do a lot more ortho cases that start to get complex. Whereas if someone has a root canal treatment that they need done, yes, I'm trained to do root canal treatments, but I'm not the best placed person to carry out root canal treatment. So I leave that to somebody else who's better positioned to do that. So that was really good for me to understand that a bit better.
And it's quite interesting because what you'll find is, unfortunately, a lot of accountants who might not have experience in tax will still dabble in tax. And so that's where you can get a difference in quality of the advice that you have. So that's the way we set up team at Black Swan Tax is we've got various specialists within the team. And we make sure that the right specialist is dealing with their specialism.
Yeah. So I used to have a frustration with my accountants.
Okay.
And part of the reason was a lack of knowledge on my part. Because I was expecting my accountant to let me know, okay, you would benefit from having a limited company or not. Or, Arnold, have you thought of doing this with your finances? Because I'm saying you're seeing my numbers, you're seeing my finances. Why am I not getting advice for how I can make the best of this? And I think from what you're saying is there's different roles that can help you in this. So okay, so my question would be, what do I need when I'm starting out?
Starting out as a dentist?
Yes.
Foundation year?
So let's talk foundation year, and then let's talk you now as an associate.
Yeah, sure. So in your foundation year, you're employed. So your tax has already been paid for you through payroll. So you don't have any responsibilities towards paying tax. Your employer will do that for you. However, you can claim expenses. So most dentists would have to register with GDC, they'd have indemnity, they'd go on courses. So foundation dentists already have, courses provided as part of the training, but we're seeing a lot of foundation dentists go on courses out of interest. And they'd have costs towards that. So the cost of the course, maybe the cost of traveling to and from the course, maybe there's an overnight stay. So all of these things can be deductible. So in the foundation year, you're looking at making sure that you're claiming all the expenses rather than worrying about having to do a tax return. Now, after foundation year is where it gets a lot more interesting.
So, all right, let's get into that. So after foundation year, you're now an associate. What do I need? Do I need an accountant and somebody who's a tax advisor and somebody who's a wealth manager? What should my thought process be in deciding what I need as an associate?
Yeah, sure. So I'm a little bit biased because of what we do, but I'll try and take my Black Swan Tax hat off and just try and be as general as possible. So when you're starting out as a self-employed dentist, your earnings increase, and it depends on what you wish to do. So if you're someone who's interested in making investments from any surplus income, then you definitely want to be speaking to a financial advisor. And you want to definitely have an accountant. But again, if you're someone who's going to be making some investments, then you want input from a tax advisor as well. So that might be from how you structure your investments to, there are certain tax efficient investments, some that even help reduce tax in the year that you invest. And so ultimately it does depend on what you're doing, and it varies for each individual. It probably doesn't answer the question.
Okay, so let me give you a bit more information to work with. So I just finished as a foundation dentist. And getting onto the property ladder was a big thing for me. Now, I guess my situation was a bit different in that I applied for my mortgage with my wife whilst I was still employed. So it was done on the basis of me being employed. But that changes when you become an associate and self-employed. So a lot of people are thinking about saving towards their first property. In that sort of scenario, who would I be needing? What team would I need?
Yeah, so in that scenario, it definitely needs a tax advisor and a financial advisor and probably a mortgage broker at some point as well. So what would happen, as you've touched upon, is that when you're going for a mortgage, they look at your salary. So you want to make sure that your records are up to date. And are you talking about property from a main residence or investment perspective?
So main residence.
Yeah. So for your main residence, you want to make sure you have an accountant or a tax advisor who's keeping up to date with your tax returns, and you need a mortgage broker at that point as well.
So what changes there if it's not a main residence and it's more of an investment?
Yeah, so you definitely need to speak to a tax advisor in terms of how you structure it. And the variables generally are that is that property an investment for long term? Or is it something you want to take the rental income from as and when you receive it and spend that money? So naturally, it'll have tax implications. You will have to think about, whether you're buying it jointly. So, for example, if we may use your example, you're married, so you're buying the property with you and your spouse. Are you buying it on your own? Do you want the children involved? Now, again, if you don't mind me using your example, your children are quite young, so it's quite difficult for them to hold property in their own name. Again, you could use trust structures for their benefit. So you can see how it can start getting a little bit more complicated. So you definitely want to speak to a tax advisor at that stage, and a property lawyer as well. So the team of professionals will change depending on what you're trying to achieve.
No, that's not the type of answer I want to hear, because I want it to be simple for me.
Yes.
You know, I want to come to yourself, for example, and say, Shoaib, this is my situation, my finances, you know, and come to you for the advice I need. Now, when you're saying that there's these different roles and specialties I need to inquire from, it starts to sound like a bit of work. Is there a way to keep it simple?
Yeah, so I mean, we as tax advisors, accountants, will be your lead advisor in most cases. And as when you need other advisors, we'd make the appropriate introductions. So whilst in my example, I said that you might need other professionals, but what we do for a lot of our clients is we know the professionals in our network who are trusted partners, and we know they look after our clients. So as and when you need it, your lead advisor would be able to make the appropriate introductions. So you don't necessarily have to. So say, for example, if you're doing a property deal once every 2-3 years, you don't need to have a property lawyer and retainer, if that makes sense. So your lead advisor would generally be your tax advisory accountant who looks after your finances on a day-to-day basis. And hopefully they will make some good introductions for you as and when you need it.
Okay, so another question would be, again, I like having one main person to contact and having that person almost be the person that works with these other people and brings them into what I'm trying to do. Is that something that can happen where I say, okay, I'm seeing yourself.
Yeah.
I want you to talk with, different individuals to work on what I'm trying to achieve? Or does it have to be, I'm always the one initiating and saying, have you spoken with this professional? And have you spoken with this professional? Because, I want to focus on the dentistry.
Yeah, 100%. So honest answer depends on your advisor. So we as advisors, we make sure that if we're leading on a project for you, so like in most recent case, we've had a family of dentists who've decided to leave dentistry and become property developers, right? So we've been their advisors for a bit, and we're on every call with the lawyers, with the property brokers, because they want us to be kept in the loop. So ultimately, it depends on how your advisor works. But for how we work, we'd be on those calls, making sure. And sometimes it's about just helping our clients kind of translate the legalese into something that's a bit more approachable. Which naturally, because we deal with kind of the tax law and we were exposed to a lot of legal matters, so we've got some familiarity. So yeah, again, your lead advisor, your tax advisor, accountant, should be on those calls and should be able to help you.
Okay, no, thank you for that. Who would I, or what questions would I ask to make sure I've got a good, let's say, tax advisor working for me? What questions should I be asking? What should I be looking for?
Yeah, so I guess maybe ask a bit about their experience, a bit about their training. There's, for example, we've got sector specialism and subject matter specialism. So we've got experience in dentistry, and we also understand tax, if that makes sense. So if you're speaking to someone who is a new advisor to you, and you're considering them, but perhaps ask them about their experience, and then I guess you make a judgment call from there whether they are the right advisor for you. And also, I guess it's a little bit about personality, whether your personalities match. I think a lot of tax planning, in my mind, is about being proactive. So you touched upon earlier that sometimes you get frustrated because you are presenting your accountant with the financial figures and they're not able to help you save tax. It's more than likely because tax year's passed, and all you can do at that point is complete the tax return and accounts, right? So there's no opportunities to be able to advise in that instance. So the way around that is making sure you're having regular planning meetings within the tax year. So that's something we actively promote. And I would recommend that if your accountant's not offering that, maybe speak to them and being proactive, because you can't change the facts after the tax year has changed, right? So you need to make sure that you arrange your affairs in a certain way with appropriate.
There's Joe the dentist who does his own taxes, and he preaches that dental taxes are straightforward. It's the same each year. So just learn how to do it for yourself, and you'll save yourself hundreds and hundreds of pounds each year. So my question is, do you think it's okay if I just decide I want to do my own taxes and figure it out on my own? What do you think about that?
Yeah, so it's personal choice, right? And is the honest response. If you want to do your own tax return, there's nothing stopping you. The HMRC guidance is available, legislation is available online. So if you wanted, you can do it. But naturally, there's a difference in the expert doing it and you doing it yourself as a dentist who may have never done a tax return. Now, in my view, a tax return is the most important document you submit to HMRC. So if that's good, you hopefully never have any other correspondence with HMRC, right? If there's any issues in that, HMRC start an investigation and there's errors, then oftentimes what happens is you'll get hit with fines and penalties, which will usually be more than any professional fees that you might have had to pay in the first instance. And it's like any profession, having an expert do the work for you, they're going to do it quicker. They are going to do it better because they've got the experience. And so, I guess I'm biased, but I would say use a specialist. But equally at the same time, there's nothing stopping you from doing it yourself. And there are no guarantees that it's right. So that's what I would say to that.
I see a bit of a parallel with, when we see the public having DIY approaches to dentistry and saying, hey, I've seen it on YouTube a couple of times. Why don't I, straighten my own teeth using a DIY approach, or take my own tooth out using a DIY approach?
Go down the road and try and whiten my own teeth. And that kind of thing, and apparently might work. Your teeth might look white, but you don't know. You might have damaged your teeth in the process. Right, whereas a dental professional would do it appropriately, and for some people, it's not even the right treatment. Right, so whitening isn't right for everyone depending on the condition of your teeth. So, I guess a similar parallel would apply. There's I guess in my mind, there's no substitute for working with a specialist.
Well, no, thanks for clarifying that. Let's do maybe tax 101. So why are we having to pay tax twice a year? Why not just one figure that we pay on a yearly basis? Why am I having to do, 2 payments each year? How are these numbers, calculated? Just why that frequency, and, how are these figures determined?
Yeah, so not everyone pays tax twice a year. So if you're employed, you pay monthly, right? The other thing, which it took me as a tax professional a long time as well, is sometimes you just have to accept that these are the rules, right? And that's the way how the rules work. So the reason self-employed individuals pay 2 payments each year, called payments on account, is you pay half of your estimated tax liability for a particular tax year. And the way that half is worked out is you take the previous year's tax liability, the return that you've already submitted, and you assume your tax liability for the future year is going to be the same. And then you pay 50%, first payment on account, usually 31st of January, and then the second payment on account by 31st of July. And as is often the case, your income isn't exactly the same year on year. So if your income has increased, you might have an additional tax to pay, and what you end up paying is what's called a balancing payment. So you've already made 2 payments, so you get credit for that, and then the difference, anything above that, you pay. Equally, if your income is decreased, you then get a repayment. But then the cycle carries on. So even though you might get a repayment, you might have more than likely a payment on account the following year. So you don't actually see the cash back. You'll see your payment on account reduce. And that cycle carries on for self-employed individuals. There is slight nuance there that if your income decreases and you know for sure it's going to decrease, you can reduce your payments on account. And again, work with your tax advisor to make sure that you're reducing to the appropriate amount, because there's penalties if you reduce it too much. So unfortunately in tax, most things attract penalties and interest. So you have to be on the more cautious side.
So tell us about the general pattern you see from foundation dentists going into their first few years of associateship. Because I was in for a big surprise when I moved from being a foundation dentist to becoming an associate. And in my first few years, seeing these big tax amounts that I had to pay. So just tell us what's happening there.
Yeah. So the big tax liabilities are because you're earning big money as well. So naturally that's a good thing. Tax generally
Doesn't feel like a good thing.
No, but we're talking about your overall income increasing, right? So tax is due on profits. So that's something to be mindful of. So you go from a foundation dentist to an associate, you become self-employed. So the one thing that changes is who is responsible for paying the tax. So when you're employed in your foundation year, your employer is responsible for paying tax by payroll. Once you become self-employed, then it's your responsibility, making sure you're keeping enough reserves. You end up paying more tax also so an average salary at the moment is about maybe between 34 to 36K for a foundation dentist. As soon as you become an associate, it usually increases to 55 upwards, right? So you're earning more, therefore you higher profits, therefore you're in the higher tax bracket. And so that basically is why you end up paying more tax.
How do I get out of it?
How do you get out of it? So there's certain strategies. Number one was making sure you're maximizing expenses.
Okay.
Right. So making sure you're claiming all your expenses. So for most dentists, your GDC, your indemnity, courses that you go on, traveling cost, any equipment that you buy like loupes, laptops, any software to do with that. Some dentists will be working from home. So as an associate, you might have some admin hours that you do at home. So you can claim expenses towards working from home. And that's one way to reduce your tax liability, as I say, maximizing expenses. You can, how you're set up as an associate. So one of the options that we often look at is whether a limited company is the next step. So if income has increased significantly, say around the 70K mark, then that's definitely a consideration you want to have. And in that consideration, there's a lot of things to think about, not just the tax. So if you're someone who is going to be on about 70K, but you only need about 40K to cover your expenses, then a company might be a good option for you. There's usually corporation tax to think about. And say if your profits are about 70,000, let's stick with the same example. Say you've got no expenses, that's all your profit. You pay tax on that. Then you take out income for yourself. So there's a personal tax element. So there is an element of double tax. But if you left the remaining, so we're saying you need 40K, the remaining after tax profits that stay in the company, there's no further element of personal tax on that. However, if you're self-employed, it doesn't matter how much you're saving. All your income is taxed. Under personal tax rules, and the rates go up to 40% from 20% once your income goes above broadly 50,000. so that's where it starts getting a little bit more interesting.
Yeah.
Is making sure you're maximizing your expenses, but also you're set up in the most tax efficient way possible. And it's personal for each individual.
Yeah.
So I'm often finding myself not giving the same answer, depending on your situation. So again, if we may use your example, so you are married, but your wife's a GP, right? So how much, if you had a company, how much personal income you take is limited to yourself, whereas you might have someone else who's employed, but their spouse doesn't work. So they may be able to give some of that income and use the spouse's personal allowance. And so if you can see how the dynamics might be different for each individual. And so it becomes very personal.
Yeah, and it gets very complex because even so, I'm incorporated.
Yep.
And there's, what's the term? Child free allowance? Something to do with nursery where
Child tax credit.
Child tax credit, that's the one. And one thing that became apparent was the fact that I was taking dividends from the company, but then when the assessment came through, they saw my income as I think pretty much zero.
Yeah, because you have to be on a salary.
Because so we're trying to explain that they're like, no, computer says no. You have not been taking an income. So, why is that difference between dividends not being seen as income and income not working the same way as dividends?
Yeah, so dividends are a form of income, but they're not salary. So salary is something the company will pay you, and it's a deductible expense for the business. Dividends is after corporation tax profits, and they may change year on year. So I guess from their perspective, salary gives a bit more certainty. It's a difficult one if you look at it, because ultimately it's still your business, right? And you decide how you remunerate yourself. So it's it's a difficult one to answer with clarity. But that's what they look at when it comes to something like child tax credit. They look at what your salary is, and so you'd have to pay yourself a minimum amount to make sure you meet something like that.
I guess we're all looking for like a simple answer in a situation where there's no simple answer, because I hear dentists say, hey, if you're earning over 100,000, that's the time to think about incorporating. And people just put these numbers out that maybe works for them, but might not work for the other person. Other people say if you are needing a lot more disposable income to be living off, maybe incorporating isn't for you. What's the best way to get a solid answer for your specific case?
Yeah, speak to a tax advisor to get a solution that's relevant for your scenario. The other thing also to consider is dentists who are looking to set up a limited company are not able to benefit from NHS pension, right? So for some people, that's an important kind of future investment that they want to carry on. So those individuals may not be able to incorporate at all. So, for non-tax reasons, that's not an option available to them. And that will only transpire in having that conversation. I'm assuming that because you're already down the company route, you don't benefit from the NHS pension. It's not a priority for you, and therefore we can have that conversation.
Is there a way to mix it up where, let's say you're one dental practice which is fully private and one dental practice which is NHS?
Yep.
Could you receive your NHS income as a sole trader, and then the private income at this other practice goes to the limited company? Can you start to...
You can. So as long as the contracts are separate. So say, for example, you're not working for same principal who's also the contract holder, because it can be, and it depends on what your contract is like. So say if you're expected to cover both practices owned by the same practice owner, but if they're two completely different businesses, you've got two different arrangements, then it might be possible.
Yeah.
to have like your private income go in a company. But again, it depends on that amount, right? So which contract is more lucrative, and also you might have like say if it's 50-50 split, right, and the NHS income is sufficient to cover your personal expenses. In that scenario, you may look to set up a company that uses a savings pot, right? So you're paying not paying the 40% tax, instead paying corporation tax rates, which the top rate is 25%, and then you use that as a savings pot until a certain point where you may be ready to invest into your own practice, investment property, something along those lines. So that could work in a certain scenario.
Is a limited company only useful for investments like a practice or property? If I haven't got an ambition of owning a practice or having a property portfolio, is there any point in me still incorporating? Are there situations where you find
Yeah. So your level of income. So you mentioned people have different targets in their mind in terms of numbers. So you might be earning quite high as a dentist and paying significant amount of personal tax, and you might not need all of that cash for personal utility. So you may look to set up a limited company to benefit from the lower rates of tax. So in that scenario, it could be that maybe you don't have anything in mind right now, but you still want to benefit from a lower tax regime. So that could also be a scenario.
Yeah, again, that's really good. I mean, you have a wealth of experience within dentistry, and seeing the numbers and the figures. How do you see that, on average, dentists' income change over the years, and maybe their working patterns and how they handle their finances? Do you see any patterns or?
Yeah, it keeps going up as they get more experience, which is great.
Are there like any landmarks that you see?
Yeah, so I think the kind of progression that we generally see is kind of two most obvious steps. One is after a few years you become a practice owner. The other is after a few years you reduce hours, and so the income would go up and down accordingly. For a lot of people, being a business owner is something they want to aspire to, and once you've got a certain amount of experience, enough savings behind you, and all that good stuff, the next step is naturally to have your own practice. And you might have worked at a number of different practices and decided that actually there's certain things I can do better in my practice, or you might want to practice dentistry in your particular way, so that's a natural step. Equally, we are seeing people fall out of love with dentistry as well, which and it's natural. It's a stressful career path.
Are you seeing that at the same? So, for example, are you seeing that with people that have been in dentistry for 30 years, or are you seeing a change in what point people are starting to fall out of love with dentistry?
Yeah, so that's something that's, by the way, not just exclusive to dentistry. That's kind of like in the general market is that people who may have stuck to a career for, say, 20, 25, 30 years previously now make changes a lot quicker, right? So that's just something not exclusive to dentistry. It's the way society is going in general. So, yeah, and I think now there's more pressure on dentists generally. This kind of the rise of social media, people putting up some really good cases, and that for some people can add on additional stress on top of it being a stressful job anyway, right? So, we have seen some examples where people reduce their hours and they've started focusing on other things like becoming a property investor or a property developer. So yeah, I think if I was to say two kind of quite different paths in that if you become a practice owner, you're going in deeper, right? Whereas reducing your hours, you're trying to take a step back and maybe look at something else.
So I hear this back and forth between associates and principals, where principals say, associates don't know how lucky they have it since they became principals. they actually take home less as a principal than they did as an associate.
Okay.
I mean, what's your take on this? What are you seeing from your side? Is becoming a practice owner dooming you to actually taking home less than you did as an associate?
That's a really good question, and let's unpack that. So, are we talking about income they're taking out of the business, or what the business is making?
Okay, so let's
Yeah.
explore both.
Yeah. So, in my experience, I would disagree. I'd say practice owners will generally make more than an associate. But then, if you remember, we touched upon when you're set up as a company and you can control how much personal income you take, then yes, I suppose you can argue that you're taking home less than what an associate might be taking home. So yeah, we'd have to get into the numbers and have a look at exactly what these people mean. But yeah,
Okay, so what could be happening is principals or owners are by choice taking home less, but really their business has made a much bigger profit.
yeah, exactly. And you would do that anyway as part of tax planning. You'd want to keep money in the business. You might want to reinvest. There are ways of making investments within a corporate structure which don't trigger any immediate tax charges. So potentially they may still be benefiting from the higher earnings, just not taking it personally.
Okay, okay. Let's switch gears a little bit.
Sure.
Let's say you are in my position as a dentist who is now becoming a principal, and you're handling the accounts. How are you going to be apportioning savings, income for your own personal income, money that you have as reserves? How are you, I use Barclays. How are you sorting out your accounts to work for you? What would you be doing?
Yeah, so I think I'd take a step back actually, and before I set up, I'd have a business plan that already has a provision for what you need personally. Otherwise, it's quite difficult if the business is not going to be able to cover your existing expenses. So that step should have already been taken care of. In terms of how you manage on a day-to-day basis, so there's cloud accounting software that are available that link to your bank account that are able to provide kind of live estimated tax liabilities. So you're running a tax pot using those. So it doesn't necessarily matter which bank you bank with, because most of these cloud accounting software are able to connect with your bank account. And it's a good way of making your admin a bit more efficient. So a lot of these cloud accounting software are quite intelligent. So say you've got one expense that is recurring every month. Once you identify it, they'll pick it up month on month as that category of expense. In terms of how you manage your affairs, I guess one of the things I always stress is being as proactive as you can be in terms of managing your potential tax liabilities. If you're looking to make further investments into, say, you've got one surgery and you want to set up a second one, being proactive about how you plan that, because you're going to have an outlay, but then you also need to think about, how long it will be before you have some inflow of cash, and how do you manage things in the interim. So that all needs to be thought through, I think.
Yeah. And then in terms of balancing that with your own personal finances, how would you sort of lay that out?
Yeah, so you need to be clear from the off. The business needs to be able to pay for you. So that's where the business plan before the start of starting your practice should have already covered that. But also, as a practice owner, you'll have expenses. You'll have some staff that you also need to pay for. You'll have various expenses for the practice, so your lab bills, your materials, all that kind of stuff. So all that needs to be covered. So when you're thinking of setting up your own practice, I guess that will have to go into the pricing as well, in terms of what you're charging your patients for various treatments. So yeah, in my mind, that should have already been thought of before you set up your own practice. Because the other thing also is, if you're being proactive about it and your business plan might not provide and meet your current level of earnings, right? And in that sense, it's also a good indicator that maybe this isn't the right time for you to go into business for yourself, or buy a practice if it's not going to give you, or equally, you could be that you're happy to take a bit of a pay cut with the hope that actually this business plan will help me earn many folds more, but in a bit more time. Yeah. So you should have thought this kind of process through.
Yeah.
And unfortunately, a lot of people don't, right? So they get into it, right? The practice owners, and then they're scrambling a bit because they're not able to take out as much as they were used to.
Yeah.
So it's always best to be proactive and think these things through.
Would you have money that patients pay for their treatments, for being on plans, and your expenses for bills, utilities, would you have that all happening within the same account? Or would you have different accounts where, money that patients pay goes into that one account, expenses from labs comes out from a different account? How?
Yeah, I think one account should be sufficient. If you want to keep things simple, equally, so some people are, a bit more organized, and they might want to run different pots where they have, expenses going through and patients paying into it. But broadly, having one account means that all your income and expenses are going out of it. You link your cloud accounting software to that, and you manage all your expenses. One thing you might want to have separate is having an account which just runs as a tax pot. So as soon as your accounts finish, your accounting period finishes rather, you prepare your accounts, you know what your tax liability is. Hopefully you've run the tax pot and been more prudent, it's just save more than you need to. And at that point, you know what your tax liability is. And hopefully you've got some savings which you can move into the business or take personally. So that's where I may run a couple of different accounts to have a tax pot. But yeah, other than that, it depends how complicated, how simple, and how you like to run things.
So my last question is, these days we're seeing associates that want to invest in themselves, and they'll go out and buy maybe their own materials, maybe their own equipment. I was talking to an associate the other day where she bought an iTero scanner, so spent more than £15,000 to progress herself with clear aligners. Is there any advice you would give to associates that are thinking about heavy purchases like that, that could help?
Yeah, so something like that, they may get what's called capital allowances. So if you're buying plant and machinery to work as a dentist, you get a tax deduction. So capital allowances essentially is tax depreciation, right? So for accounting purposes, you can depreciate whatever rate. However, for tax purposes, you're given fixed rates within the legislation, and then you follow that. So again, I'll come back to have a chat with your tax advisor, because there might be timing issues. So say, for example, your income is increasing the following year, right? We say we're in March, and this is when you're looking to make this expense, but we know going forward, you're going to be making a lot more in the following year. So you may want to delay that expense to get a deduction at a higher tax rate. So you can have these kind of conversations. But broadly, if you are... So a scanner, where would the associate use that?
So it captures a 3D image of the patient's teeth, and it might be able to show a simulation of how their teeth would look once they're straightened. Or you might just use it to...
Where would they keep it? Because it's quite big, isn't it?
That's a good question. Yeah. So it might be so there's two ways. Some are portable, where you take it from practice to practice.
Right.
Maybe you just leave it in your car.
Oh, okay. Yeah.
Some it might be that the associate leaves it within the practice.
Right. Okay.
Yeah.
That's interesting. I mean, I would say if they're using it for their work as a dentist, then it will be a tax deductible expense. But given the amount you mentioned, definitely want to have a chat before they have that kind of an outlay. Getting the timing right in terms of when they're going to be able to get the best tax impact for them.
Yeah. No, that's really good. I mean, we've covered a whole lot in this session. What lasting comments or summarizing comments would you give for dentists just wanting to make sure that they're getting the most out of their income by, talking to the right professionals?
Yeah, so I would say, and I guess having to repeat myself, being proactive is so important. It is the key to saving a few £100 of tax or paying a few £100 of tax. Oftentimes, record keeping really important. Oftentimes,
When you say record keeping,
yeah,
what specifically do you mean by that? Receipts?
yeah. So keeping all your receipts. So as a taxpayer, it's your responsibility to keep all documents that you claim in your expenses and also in declaring the income. So normally when you prepare a tax return, you don't have to attach the receipts. You just submit a tax return. However, HMRC can inquire into anyone and they can ask for those documents, and you're supposed to keep them for 6 years. If you don't, there's penalties, right? And also what HMRC can do is if you don't have a receipt, they can disallow that expense, which again is going to really increase your tax liability, fines, penalties, interest. So record keeping really important. And I advise a lot of individuals nowadays it is quite easy to be able to, we can get G Drive or OneDrive, so cloud storage system on our phones. And if you got a receipt, you just take a picture and you can upload it there and then. And what I would do is have a folder for each tax year. And if you don't want to go beyond that, just keep dropping your receipts in there, and then it's there. You don't have to worry about it. If you want to be a bit more organized, you could do it by month, by the category, and so on and so forth. But at basic level, having a folder for a tax year and keeping all your records, and then once it's on the cloud storage, it's hopefully there, secure. And if you lose the paper receipts, you've got a picture or a scan of it, and you're good. I think the third thing I would say is being aware of deadlines. So as a dentist, you're generally self-employed, right? So there's various tax and accounting deadlines to be aware of. So depending on how you operate, if you're self-employed, then you've got your July, your January deadlines, and try and be as early as possible in getting your details over to your tax advisor, accountant, so they can prepare your tax return and the liabilities as soon as possible, giving you some time. Equally, if you're operating as a limited company, then you've got your accounts and your company tax returns deadline, your company tax payment, and your personal tax payment. So being aware of deadlines and speak to your advisor. They'd be able to tell you when your deadlines are, and most advisors will want you to get in as early as possible, so they'd welcome that conversation. So those are my I guess 3 tips: proactivity, record keeping, being aware of deadlines.
What makes tax so exciting for you?
What makes tax so exciting for me is being able to add value to our clients, being able to save them money. It's not always possible, depending on what time they get in touch with us. But being able to add value and help families. We advise a lot of family businesses, and it's just nice to be able to make a positive contribution. Not so much as a dentist, but on some level, being able to make a positive contribution.
No, thank you so much for this session today. I've learned a lot. Cool. You've demystified a lot as well, simplified things for me. And we're going to have to do a part 2 at some time in the future.
100%. You're more than welcome. Thank you so much for having me. And I do hope this has been useful. Or if you've got any further questions, you know where we are. Get in touch.
So actually, with that, what is the best method of getting in touch with you?
Get in touch with me.
Yes.
You can go on our website, put an inquiry through there. You can email me, Shoaib.Khan at blackswantax.co.uk, and be happy to hear.
All right. I'll put the details in the description. And thank you for this again.
Thank you for having me, Arnold.